You're earning £45,000 a year, which in Britain, people keep telling you is a good salary. But in reality, you're broke. But your dumbass thinks you've done everything right. You didn't waste your 20s in Ibiza every weekend. You saved some money, you stayed out of stupid debt. Now you're thinking about buying a house. So naturally, at midnight, you open Rightmove. And suddenly, reality punches you in the throat. Every house that doesn't look like a condemned building costs £450,000. The kitchen still has cabinets from 2002. The carpet is that depressing landlord beige. The bathroom tiles look like they were installed during the Blair government, and the estate agent has the nerve to call it a perfect starter home. Meanwhile, your mortgage broker is smiling. Good news! You're approved. Your parents keep asking when you're going to stop renting. Your mates are posting house keys on Instagram, so you start thinking the problem must be you. Maybe you're just bad with money. Maybe everyone else understands something you don't. Maybe you're the idiot. Except here's the truth nobody wants to say out loud. You probably can't afford those houses. Not properly, not in a way that doesn't turn your life into a financial prison for the next 20 years. And the most stupid part of this entire system, not a single person involved in selling you that house has any incentive to tell you that. Not the bank, not the estate agent, not the mortgage broker, because the moment you sign that paperwork, they get paid. So today, we're going to do something the UK property industry absolutely hates. We're going to calculate what house your salary actually buys you. Not what the bank says you qualify for, what you can actually afford without living on Tesco meal deals and praying your boiler doesn't explode. Let's start with some uncomfortable maths. Because once you see the numbers, the whole system starts looking stupid. The average salary in the UK is roughly £35,000 a year. If you're earning £45,000, people say you're doing well. Middle class, stable job, responsible adult. Now open Rightmove again. The average house price in the UK is around £285,000. In London, closer to £520,000 for what is basically a two-bed terrace with a kitchen the size of a wardrobe. So let's translate that. A normal person earning £35,000 is expected to buy a house that costs 8 times their salary. 8. Imagine earning £35,000 a year and someone tells you to buy a £280,000 car. You'd laugh. You'd assume the person saying that is an idiot. But when the product is a house, suddenly everyone acts like it's normal. Estate agents say it's the market. Banks say you're approved. Your parents say property is always a good investment. And slowly, people start believing something completely ridiculous. They start believing that if they can't afford the house, then the problem must be them. Maybe they didn't save enough. Maybe they should have worked harder. Maybe they're just bad with money. But here's the truth. The maths is broken, not you. And once you understand how the bank actually calculates affordable, you'll realize something slightly disturbing. The system was never designed for you to be comfortable. It was designed for you to barely survive the mortgage. Now here's where things get properly stupid. The bank says you're approved, and the moment people hear that word, their brain switches off. Approved must mean affordable, right? Wrong. Banks don't approve houses you can comfortably afford. They approve loans they think you probably won't default on. That's a very different calculation. The bank's job isn't to protect your lifestyle. Their job is to protect the loan. As long as you keep making the payment every month, they don't care if the rest of your life becomes financially miserable. Think about it. The mortgage broker gets paid when the loan closes. The estate agent gets paid when the house sells. The bank gets paid for the next 25 to 35 years. Not a single person in that entire chain gets rewarded for telling you, mate, this house is too expensive for you. So instead, the system quietly pushes you to the limit. The bank uses something called debt-to-income ratio, which basically means they're calculating the maximum amount of financial pressure you can survive before you completely collapse. In the UK, that number usually sits somewhere around 40 to 45% of your income. Let that sink in. Nearly half your income going straight to housing. Imagine handing over half your paycheck every month just so you can sleep in the building. That's not financial freedom. That's a mortgage with a side of anxiety. And this is the part people hate hearing. Just because the bank says you can buy the house doesn't mean you should. Let's run the numbers properly, because this is where the fantasy disappears. Imagine you buy a £450,000 house. Nothing fancy. Just a normal 3-bed semi somewhere outside London. The kind estate agents love calling perfect for first-time buyers. You scrape together a 10% deposit. That's £45,000, which probably took you 5 or 6 years to save. That leaves you with a £405,000 mortgage at roughly 5.5% interest right now. Your monthly mortgage payment, about £2,400, and we're not even close to finished. Add council tax. Let's say £180 to £250 a month, depending on the band. Then home insurance, another £40 to £70, then maintenance, roofs leak, boilers die, things break. The usual rule is about 1% of the property value per year. That's another £375 a month. Suddenly your £2,400 mortgage becomes something very different. More like £3,000 a month just to own the house. And that's before gas, electricity, water, internet, or fixing anything major. Now here's the uncomfortable question. What income actually supports a £3,000 monthly housing cost? If you follow the SAFE rule, housing should be about 30% of your income, which means to comfortably afford that £450,000 house, you'd need to earn roughly £120,000 a year. But the bank might approve you with an income closer to £70,000. See the gap? There's a massive difference between what the bank says you can survive and what you can actually afford without turning your life into a permanent stress test. Now imagine someone earning £70,000 a year, which sounds like a solid income in Britain, 2 decent salaries in a household, maybe £3,800 to £4,000 a month after tax, respectable, responsible adult life. They buy that £450,000 house. The bank approves them. The estate agent congratulates them. Keys in hand, photo outside the front door. Everyone claps. Then reality arrives. Their housing cost is roughly £3,000 a month, which leaves about £1,000 for everything else. Food, transport, car insurance, fuel, council tax adjustments, internet, phone bills, unexpected expenses, life. Now something small breaks. The boiler goes. That's £3,000. Or the car needs repairs. That's £900. Suddenly the credit card appears. Then another one. Then the overdraft. This is what being house poor actually looks like. You technically own a house, but the house quietly owns your entire life. You stop investing, you stop saving, you stop taking risks, because every decision is now controlled by one thing, the mortgage. And here's the stupid part. From the outside, it looks like success. Nice house, driveway, postcode upgrade. But financially, you're walking a tightrope every single month. One unexpected expense away from stress, one interest rate jump away from panic. That's not wealth. That's a very expensive illusion. Now, this is the part where someone older usually says, well, we managed to buy a house. And they're not lying. They did. But they bought in a completely different economic universe. In the early 1990s, the average UK house cost roughly 3 times the average salary. Today, it's closer to 8 times in many parts of the country. Your parents were buying houses that cost 3 years of income. You're being asked to buy houses that cost nearly a decade of yours. Yes, interest rates were higher back then, sometimes painfully high, but the actual purchase price was reachable. Saving a deposit took a few years, not half your adult life. And here's another difference nobody talks about. Most people back then didn't graduate with £40,000 of student debt. They didn't have £500 monthly car finance payments either. A single income household could realistically buy a home. One parent working, one staying home, mortgage approved, job done. Today, most lenders want 2 incomes just to qualify, and even then, you're stretched. So when people say, you just need to work harder, or stop buying coffees, they're comparing 2 completely different economies. One where housing was accessible, and one where housing has quietly become a luxury product. You're not imagining it. The ladder didn't just move higher. In many cities, they pulled the ladder up entirely. So where does this leave you? Because once you see the numbers, you realize something uncomfortable. For a lot of people, the traditional property ladder doesn't work the way it used to, which means you've really got 3 realistic options. None of them are glamorous, but all of them are smarter than pretending the maths works. Option 1, you move. I know, nobody likes hearing that, but earning £60,000 in London is not the same as earning £60,000 in Leeds, Sheffield, or Manchester. In some cities, that same income buys you a house. In others, it barely buys you a parking space. This is called geographic arbitrage. You earn money in one market, but live in another, and suddenly the numbers make sense again. Option 2. You buy way less house than you think you deserve. Smaller place, further commute, less impressive postcode. Not exciting, but financially, it gives you breathing room. And breathing room is something most homeowners don't have. Option 3, you delay buying entirely. And yes, that sentence makes estate agents very nervous. You keep renting, you keep investing, you increase your income, you build flexibility. Because there is no prize for buying a house you can't afford, no medal for being mortgage rich and cash poor. And if someone tells you otherwise, they're usually the person getting paid when you sign the paperwork. Here's the truth most people don't want to hear. You're not failing at home ownership. The maths changed. For decades, buying a house was the obvious move. Prices were lower, deposits were reachable. One income could carry the mortgage. Today, the system quietly expects something very different. 2 incomes, massive deposits, and a willingness to live under financial pressure for 30 years. And if you question that, people act like you're the problem, like you're irresponsible, like you just need to stop buying coffees. But look at the numbers. A £450,000 house isn't a starter home. Not for someone earning £40,000, not even close. Stretching to buy it doesn't make you successful. It just makes you fragile. One job loss, one interest rate jump, one broken boiler, and suddenly the entire plan starts wobbling. Real financial strength looks very different. It looks like margin, savings, options. It looks like sleeping well at night, because your house payment doesn't control your entire life. And this is the part nobody in the property industry will ever say out loud. Just because you can qualify for the mortgage doesn't mean the house will improve your life. Sometimes the smartest financial decision you can make is simply refusing to play a stupid game.